From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day. Happy Friday the 13th. Here are the top market stories that we're following for you at this hour. Musk's Twitter turbulence. Elon Musk puts his deal on Twitter on hold to examine fake accounts. He stays committed. Shares bounce off their lows. Capitulation fever pauses. Bank of America says the mass exodus has begun as investors sold over $6 billion in equities this week, but now they rebound on Friday the 13th. And Merck's up against inflation, war, and a slowdown. The company sees as much as 9% sales growth this year. We're going to speak to the CEO about the risks bubbling up. From New York, I'm Alix Steele with my co-host in London, Guy Johnson. And welcome, everyone, to Bloomberg Markets. Yeah, we're up now. I don't know. Friday the 13th, I'll put nothing past the market.
Happy Friday the 13th. That doesn't sort of go together in my mind. But anyway, we'll see what happens. Like, my expectations for this show, pretty low. We'll see what occurs over the next couple of hours. The data initially aren't exactly giving us a great start, Alex. So UMich is breaking right now, and it doesn't look particularly clever. So let me just work you through the numbers to show you what is happening here. The headline number comes through at 59.1. That's down from 65.2. The markets, the economists, were looking for 64. Current conditions down to 63 from 69. Market was looking for 69.3. Expectations down to 56.3 from 62.5. 1 year inflation expectations actually quite stable, as are the 5-year expectations. Alex, it's that headline number that looks a bit scary. The consumer may be starting to get a little bit frightened here.
Yeah, but I do find it interesting that the inflation expectations are unchanged. They are still quite high, I mean, that 1 year at 5.4%, but unchanged. So have we kind of peaked out in consumer inflation expectations? And then does that kind of soften maybe the consumer sentiment going forward? I don't know that yet.
My 2 cents on that is that the market is going to be a little bit nervous about that number, because we're going from this rate scare to this growth scare, and that would maybe start to provide some more evidence in terms of numbers that maybe things are turning a little bit more difficult. But maybe it's just Friday the 13th. Anyway, that's one of our big stories, what is happening with the macro story. The other one is obviously a much more granular story, and it's the one that pretty much everybody is obsessed with. So our question of the day is Elon Musk really committed to buying Twitter? And I guess there's a ... after that, which is at what price and on what terms. Joining us now to kick this around is Alex Webb of Bloomberg Quick Take and Bloomberg technology correspondent Ed Ludlow, joining us from San Francisco. Ed, how would you answer that question?
The market thinks the probability of the deal happening is decreasing, right? I think as of the open, the spread on this deal happening is at $13.80. That's a soft indication of sentiment, but basically the spread, of course, being the gap between current share price and where Elon Musk offered, $54.20. But ultimately, this is a man that keeps us second guessing, right? We have no idea what's going on inside Elon Musk's head. All we know is that he went on stage at the FT Car conference and basically cast doubt because he was asked, would you reinstate Trump? And he said, well, I'd reinstate Trump to the platform if I actually buy Twitter. It may not happen, were his words. And then he comes out this morning saying that temporarily the deal's on hold because he doesn't trust a regulatory filing Twitter put out, which says that less than 5% of users on the platform are bots. He's questioned it time and again, and all we go to is the market reaction.
So one part of that is saying, OK, he wants a cheaper price. Alex, the other part is that he just really didn't do his due diligence, and that the tech sell-off has hammered the shares so much that he's like, yeah, OK, I'm going to get it for cheaper, but I don't want to pay a breakup fee.
Yeah, I mean, some of the theories are that he's tweeting this in order to test the market and see actually where Twitter would land if there was no deal in place. Sometimes I wonder whether we're crediting him with too much 3D chess. If he's on the West Coast at the moment, which is a big if, we don't know. He tweeted this at 2:44 in the morning. So, you know, it could just be he read a story. Maybe he just tweeted something as a joke, that he saw this story and said, sure, I'm going to cancel this deal because of this number. Like, he meant that perhaps sarcastically. Like, it's one of the problems with this communication by Twitter is that we don't get clarity on these things, which means that then when you think about the SEC, that's why they like public statements, and they like statements to the market. and therefore surely they will end up examining this with some vigor.
Potentially other things happen at 2 o'clock in the morning, but we'll park that thought for the time being. Would it be reasonable to have cold feet, though?
I mean, for sure. Like, one of the big problems is that Twitter was already trading at a very generous multiple compared to its social media peers. It was trading at about 56 times its forward earnings. Facebook trades at 12 times its forward earnings. Now, you could say that's because there was already growth expectation built into the Twitter share price. And so if that expectation is already built in, where do you see it going from here? Now, he seems to have got banks on board by saying that he does have a financial vision for this company. We don't quite know what that vision is. One of the things he had mooted was something to do with spam bots, which then begs one further question. If he's carrying out a review based on this spam bot data, is it because there are too many, or is it because there are too few? Because if there are more than he had expected, then that might be the problem. Or if there are fewer than he's expected, it reduces his upside because that's the problem he's trying to solve.
I just want to jump in with a quick point, guys. Yeah, look, we're all forgetting one key point. Musk waived the due diligence on this. In the very early stages of this deal, it came together very quickly. He waived the due diligence, which was largely relating to his ability to look at the company's finances, right? You remember, he tweeted as well, I don't need to look at it anymore. But to now second guess the kind of quality of the platform, it's kind of inconsistent, right? The only thing he has been consistent about is that he wants to remove bots from the platform. If you think about his public appearances at TED Talks, the tweets that he's made, other comments, what we know about the fundamental changes he wants to make is he wants to deal with this bots issue. But now he's come out this morning and questioned the level of bots. It kind of seems to be inconsistent, right?
Well, that also raises my question, too, is we're ignoring Tesla in this conversation. And I also have to wonder how much of this is actually trying to put a floor under Tesla shares. I mean, the report yesterday was that we were looking at preferred equity versus a margin loan that was going to be $12 billion, that's been reduced to $6 billion, that might be reduced to $0. Right. And I wonder how much of that's playing into this, Ed. Yeah,
for me, this is really key. That, according to Bloomberg sources reported on Thursday, he wants to boost the equity portion further by an additional $6 billion or so, in addition to the $7.1 billion of equity financing that were added to the structure of the deal a week ago. As you say, Alex, that took the margin loan component from $12.5 billion to $6.25 billion, secured against a very hefty chunk of collateralized Tesla stock. And you see the kind of relief in Tesla shares this Friday morning. But there's a bigger point here. Musk has always borrowed money against the value of his Tesla holdings. This Twitter deal is not the only mechanism which he does that. He's always done it. He's joked about being cash poor and not taking a salary from either Tesla or SpaceX. Now, you know, we don't know what the margin call number is. We just don't know what it is on this particular deal. But the shares put up, we have data on those shares from a year ago, and since then, the value of Tesla's stock has gone up. So he seems to be sitting pretty.
Alex, one final quick question. What are regulators going to see in all of this? Is there a problem for Tesla in this, if there is a problem with the bot numbers? Twitter. Is there a problem with Elon Musk in the way that he's conducting himself? Is there a regulatory problem here as well?
So there are three things. Firstly, if it's true that he is reviewing it, then maybe he shouldn't be announcing it on Twitter, so regulators look at it. If it is not true that he's reviewing it, why is he saying it on Twitter? Regulators will be looking at it. And the third thing is that I think that the agreement, he's trying to buy Twitter ostensibly to empower free speech. Well, if he ends up with his speech being even further throttled as a consequence of this effort because they crack down on these tweets, it, for him personally, might achieve the opposite effect.
Really great conversation, guys. Super appreciate. We'll be following this throughout the next couple hours. Ed Ludlow joining us in San Francisco, and Alix Webb of Quick Take. Thanks, guys. All right, well, coming up, we'll continue the conversation how the tech world has changed dramatically since Elon Musk made his offer for Twitter. We're going to talk with the founder and president of Vital Knowledge Media, Adam Christofouli, coming up next. This is Bloomberg. It is our question of the day. Is Elon Musk really committed to buying Twitter, ... Really, at what price? You have all equities in the green today, NASDAQ 100 up by almost 3%. Let's see what's happening now with Musk. I want to bring in founder and president of Vital Knowledge Media, Adam Christofouli. Adam, in the beginning, when Musk announced this deal, you said that $54.20 was actually too low to pay for Twitter. What do you think he's going to have to? What do you think he's wind up paying now?
Well, I think the whole tech world has changed. The whole world has really changed, but especially the tech world since he came out with that offer. You've obviously seen a collapse in stocks for a variety of reasons. You've had some very disappointing earnings out of tech. You've had the backup in rates. You've had Fed tightening. You've had the shutdown situation in China. So all that has contributed to a huge re-rating in tech valuations, most likely, perhaps not a permanent one, but one that will likely last for a very long time. So I think Musk saw what occurred in the market. I think he saw what occurred with Tesla also, which is a big foundation for, the wealth that's going to fuel his bid. And I think he is angling for a cheaper price. So that's going to be the $60,000 question is what price gets the deal done. He certainly has a lot of negotiating leverage right now, just given how there are few other buyers, given what's happened with tech. And you've also seen a lot of changes within Twitter since the deal was announced. You had yesterday a couple of senior departures. So, the company is ready to be acquired. And I think Elon is attempting to kind of just lower the price here.
Okay. We don't know what that price will be, but what we can do is try and work out what we think it's worth. Adam, what do you think Twitter is worth right now?
It's really hard to say. You do have in the last couple of days, yesterday, you saw some buying in the tech stocks that have been really washed out and out of favor. Obviously, you have an extension of that rally again today. So if you see somewhat of a floor getting put in underneath the stock, you're probably looking at something in the mid to high 30s. That would probably be a floor as far as a Twitter valuation, but it's really up in the air. I think a lot of it will be dependent on the market. There's supposed to be a Twitter shareholder vote that takes place when the offer is made. So, he spoke earlier the week at the Financial Times event, as your prior conversation noted, and he sounded a bit ambivalent. And I think a lot of that just has to do with how in flux tech markets are right now. And I think a big concern was also what was happening with Tesla shares. So this can obviously really, create somewhat of a relief as far as concerns about further sales on his part.
Hey, Adam, do you think that this further emboldens any kind of short sellers here? I mean, Hindenburg Research was already short despite Musk's bid for Twitter. Do you think that this kind of ramps those positions up?
It's hard. I mean, you're dealing, with information that is getting tweeted out, at all hours of the day. So it's a really, really difficult situation right now. I don't necessarily know if I would be aggressively short it right now at these levels, but I certainly think 54.20, is looking very increasingly unlikely to be the final bid to the extent there is an acquisition.
Adam, is Twitter worth more?
Sorry, go ahead.
Carry on.
No, go ahead.
Is Twitter worth more with less than 5% spam bots or more than 5% spam bots?
Presumably those bots are skewing kind of the impressions as far as advertisers are concerned. So I think from the market perspective, if they were to come out with a much lower, user figure, that would probably spook some people, but advertisers would probably appreciate the greater transparency, and that could help attract more advertisers to the platform. So if the objective here is to provide a really thorough view of who is using Twitter to advertisers, I think, again, you could probably see ad rates actually tick higher. Markets, again, would be spooked maybe on the headline about, a drop in monthly average users or daily average users. But I think advertisers would probably appreciate, a more cleaned up platform.
Hey, Adam, so Twitter's down, Tesla up, right? You have the NASDAQ 100, you're really flying higher here, 2.8%, S&P up by 2 percentage points. And I'm just wondering what your read-through is of a Twitter and Tesla dynamic into the broader market.
I think one of the contributors to the tech slump, there's been many contributors, has been this concern that Elon would have to sell a big chunk of Tesla shares. So I think removing that overhang is one of the reasons why you're ticking higher today. You have a couple of other things as well, including some of the news out of Shanghai overnight. But like I said, the bombed out tech stocks have been acting well now for the second straight session, which is somewhat encouraging as far as tech possibly finding a floor here. In which case then that could help Twitter shareholders as far as the price cut that Elon is seeking being a little bit lower than feared.
Okay, let's put you on the spot. Does the deal get done, yes or no?
I think it gets done, but at a lower price. Lower price than 54.20.
Certainly lower than 54.20. Yeah. And in terms of that bombed out, Do you think we are bombed out now? Do you think we're getting near a floor in tech valuations? Because if you take 2000 as a precedent, potentially we've got a lot further to go.
I think that you are at least for the near term, you've had such aggressive, violent selling that you are at a level where you're going to see some of these names find a floor. I don't, though, think you're going to return back to the levels where we were just even a few months ago. I think you had a 90s-like tech bubble that occurred during the pandemic that has popped. So a lot of these stocks are going to be trading at these current depressed valuations for a while. I thought the Interactive Corp, their earnings report, they put out a very interesting comment in their shareholder letter, which I encourage people to read, just talking about how they think that you've seen a permanent resetting lower in tech valuations. And this is something they actually welcome, because they are looking to possibly add to their portfolio of internet companies. So I think for, a firm like that takes a real hard look at doing M&A in the group. I thought it was an interesting comment for them to make, that they think that these valuations are going to be permanently reduced for the foreseeable future.
Yep, for the foreseeable future, and permanent may not go necessarily in the same sentence, but I take your point. We could be down for a while. Adam, great to talk with you. Thank you very much indeed for joining us. Have a great weekend. Adam Crisafulli, Vital Knowledge Media founder and president. Thank you very much indeed. Still ahead, why market volatility isn't going away anytime soon. We're going to talk to the chief market strategist at Crossmark Capital Investments, Victoria Fernandez, next. This is Bloomberg.
Stocks are higher today with the S&P up by 2%, but capitulation was all the talk this week. Let's get another take on it with Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Victoria, you had Michael Harnett of Bank of America saying that this was the start of the max exodus from equities, $6 billion plus from equity funds this week. What do you think?
Well, Alex, when you have excess money in the market, where does it go first? It goes into risk assets. And then when you have liquidity come out of the market, that's the first place you see it come out of as well. So I don't think it's surprising that we saw a lot of the volatility we saw this week, especially when you look at some of the crypto names or some of the more high-flying tech names, those high valuation names, those riskier assets. It makes sense that they would be the first to really kind of come down as liquidity starts to come down. But I think you have to watch. I'm not all in on the camp that we're having capitulation at this point in time, or that we've hit a bottom. I mean, nobody calls that exactly, but you look at the VIX is at a 30, and typically you don't see that capitulation until you get the VIX around 40. You usually have at least half of the S&P that is trading below its 65-day highs or 65-day averages. We're not at that number yet there either. So I think there might be some more volatility, a little bit more to go here on the give and take on a daily basis before we see true capitulation.
Victoria, good morning. It's Guy. Our last guest was raising the possibility that what we're seeing here is a permanent reset lower for growth names and their valuations. Do you buy that? Is that an idea, do you think, that has some credibility?
Well, Guy, I think there's credibility in the fact that we're having a reset. That's for sure. I don't know if it's what we would consider a new normal, but definitely a reset from where we were during the pandemic, the heart of the pandemic. I mean, obviously, we saw some of those growth names just have tremendous moves higher, and they were unsustainable. So we knew that was going to have to come back. We actually think you can use that as an opportunity if you're underweight some names. Take this as your chance to start building that position back up a little bit. I'm not sure we stay at these levels for an extended period of time, but I do think you're getting a reset here. So use that when you're trying to build your portfolio as chances to make your shifts.
So, Victoria, does that mean that you're going to be nibbling here at some of the longer-term growth names, like the big guys, and versus, say, value?
Yeah, we have been. We actually had an overweight to value for most of this year. We saw over the last few months kind of that benefit of value versus growth start to diminish a little bit. So we are picking up a few growth names here. Microsoft and Apple are names we hold in the portfolio. We continue to hold both of them. We actually nibbled at Apple a little bit over this week because we saw the name come down and we had become underweight in our portfolio. So, I mean, we're doing what we're telling other people to do. We are being opportunistic and nibbling at these names in order to build your positions.
Victoria, I was reading back through some of the notes you've sent us over the last few months as we've interviewed you. And I think it was back in September, you started raising the possibility of picking up a little bit more cash in the portfolio. How much cash do you have in the portfolio right now? How defensive are you positioned in terms of where you would normally expect to be?
Yeah, we've raised our cash position a little bit, but we're not taking a huge bet on cash right now, Guy. And I think really, for us, it's more becoming a little bit more defensive, maybe in some of the names that we have in the portfolio. So we've added to some healthcare names, which makes sense for us. When you look at our fixed income portfolios, we actually have built a little bit more cash, which has been beneficial to us, even though we're still short duration. We're having a little more cash. Not only does it help you be a little more defensive in volatility, but it gives you kind of some arrows in your quiver. So when you see a move that makes sense to you, when you see a name that hits a valuation level and it's a name you've wanted to put in your portfolio, then you have the ammunition to go ahead and move on that.
We saw a consumer sentiment read from you, Mish, quite low, decade low. What do you do with consumer stocks right now?
You know, it's interesting because the consumer has really been the heart of this economy. It's been driving the growth that we've seen over the past few years. And so the consumer continues to be strong. I know sentiment comes down, but the sentiment numbers that you get in some of these surveys are very different from someone sitting at home and spending their money. Obviously, inflation is taking a hit with some of that, but we're seeing credit card spending going up. We're seeing the loan pipeline at banks continue to do well, and household balance sheets continue to be strong in this. So even though sentiment is a little wobbly at this point in time, I still think you have to bet on the consumer and the strength that they have to support the economy.
Great to catch up. Victoria, thank you very much indeed this Friday. Crossmark's chief market strategist, Victoria Fernandez. The S&P didn't miss a beat on that University of Michigan data. I have to say, we're at session highs. Coming up, the outlook for retail in a time of inflation. We're going to talk to the CEO of e-commerce company Boxed, Che Huang, next. This is Bloomberg.
We are an hour into the U.S. trading session. No scary trading yet. Stocks flying higher. S&P having its best day since May 4th. Abigail Doolittle is taking us through the latest. Abigail?
Well, Alex, we do really have a significant rally here on this Friday. The S&P 500, as you were mentioning, having its best day. And this is true, too, for the NASDAQ 100. The best day in more than a week. Big gains here, more than 2% for the S&P 500. The tech-heavy NASDAQ doing even better. The Golden Dragon China Index up 7.7%. Its best day since the middle of March. So the risk on that we are starting to see a little bit at the end of yesterday, the reversal for some of the tech stocks extending into today. Some of it had to do with Apple, because Apple yesterday down its lows, down more than around 5% after 5% the previous days, finishing off the lows. Today we have a rally up 2.5%. This is very important. If we take a look at a chart of Apple, we are going to see that this stock, the heavyweight, the biggest weighting to all of the indexes, is holding critical support. This is a 10-year chart of Apple on a weekly basis. So what we're looking at here in red or pink, that is the 50-week moving average. Very important in green, the 100-week moving average. You can see that yesterday Apple hit it and is holding it like a glove. That's exactly what happened back in 2020. And then you had this 200% rally off of those levels. However, other times when that level has not held, it's gone down to the 200-week moving average. Right now, the dip buyers are holding Apple and to some degree holding the markets up as well. But Apple and other tech stocks are getting a big help from the fact that on the week, yields are doing something that they haven't done in a long time, and that is coming in. We have this 10-year yield right now down 20 basis points. Up today, but overall on the week lower. So tech stocks finally reacting. And then finally, because we do have yields in, we have the high beta stocks in play. Twitter in particular up 5.2%. This, of course, may have something to do with the fact that, as has been covered all morning, Tesla up 5.5%, having to do with the fact that Elon Musk's bid for Twitter is on hold. Maybe some thought that more attention will go to Tesla there. Take a look at the Ark Innovation Index, or ETF, up 10%. Cathie Wood's ETF, its best day ever going back to 2014. That's the degree of animal spirits pushing stocks higher. Rounding it out, Guy, take a look at the meme stocks. We have GameStop up 13.7% after rallying about 10% yesterday, and Mullen up 19%. So it seems like the dip buyers, the risk buying, it's certainly in full effect on this Friday.
All right, good stuff. Thanks so much, Abigail. Really appreciate it. At the same time, you had consumer sentiment dropping to a decade low, and that's not affecting the equity market. But there is a part of that story that we need to focus on, and that is the consistent rising inflation. And yesterday, you had the World Agricultural Supply and Demand report out, and there was something very interesting that happened. Global wheat stockpiles are going to decline to a 6-year low. There's many reasons for that. Obviously, the war, Russia's invasion of Ukraine is a big one. Weather is a big one. But this is quite significant. If food prices may have rolled over a touch, but when you have this kind of shortage, it's not going to get fixed anytime soon. Also, corn planting may not be as good as we thought. USDA is calling that sooner than they normally do. All of this adding to inflationary and price pressures that aren't going to be necessarily temporary, Guy.
Yeah, and that's the issue that everybody's trying to figure out. How long is this going to last? How do I reposition my business to figure all this out? What are my input costs ultimately going to look like? And how strong is the consumer going to be in terms of buying my stuff? Food is definitely front and center right now. There's a lot of articles being written over in the UK about it right now. The era of cheap food may be starting to come to an end. Retailers, so as I say, lots to juggle. You got the labor shortage, you got the supply chain issues, you got the highest inflation in 4 decades. How do you deal with that? Well, let's talk to one company that's trying to do that right now. The CEO of e-commerce company Boxed, Che Huang, joining us now to give us a take. Che, this is the issue. Everything is very, very volatile right now. We don't know where the consumer is going. We don't know what the input story is going to look like. How are you managing it from your business's point of view?
Yeah, Guy, it's a pretty wild time in the industry today. The good thing about the food industry is that it's not discretionary spending. People have to spend. People have to have toilet paper. People have to have food on the table every single day, every single night. So with that said, what you're seeing is actually puts and takes. So consumers trading up in terms of quantity, potentially buying in bulk. I know it's self-serving, but that's what we do. But also trading down as well to hard discounters, to dollar stores. When you look traditionally at the data, that's really what's happened during recessionary times or during inflationary times.
Do you have a sense of if people are buying anything specifically differently? I understand kind of buying in bulk or buying on the cheap, but in terms of what they're buying, is that shifting?
Yeah, we're starting to see a little bit of a shift towards private brands. You're starting to see that, I guess, industry-wide. So that private brand that you might have skipped over when inflation wasn't so robust and also when the economy was potentially a little bit better. Now you're taking a second look to say, hey, you know what? If it's a commodity product, can I save $5 this week or this month on it? Why not? A lot of the private brand items that we sell and everyone sells are much better in quality these days.
So what are you actually seeing? What is the consumer doing right now? We had some data out at the top of the hour that suggested that the consumer is feeling significantly less optimistic. What is happening already? Is this a kind of an idea for the future that people are going to trade down and do that as they react to these higher prices, or are they doing it right now?
I would say there's 2 data points I can give you guys. So one is, we just announced earnings this past week where we showed actually AOV, our average order value, was up over 16% year over year. So that's not just on prices, but that's on units sold as well. So folks coming in, consolidating trips and actually buying up and buying a bigger basket to potentially save on that transportation cost. The second thing that we're starting to see is actually the click-through rates and actually how consumers are responding to, I guess, re-engagement advertising or re-engagement emails or re-engagement push notifications. It's going up when the messaging is right, when you're talking about inflation, when you're talking about gas. This is very much the zeitgeist for everyone today, and you're seeing that in the click-through rates.
That's quite interesting, Che. I wonder how sticky you feel like these changes for consumers are. Let me just take the other side of this. Let's pretend that all of a sudden inflation actually comes down quickly, or the Fed actually works in destroying inflation expectations to some extent. How quickly do you think consumers are going to go back to old spending habits?
I can only speak on behalf of the data, Alex. And so
Yeah.
what we've been seeing throughout the pandemic is that, of course, there was a huge spike in 2020, 2021. 2022, we saw a regression back to the mean. So folks are spending as if it was pre-COVID days. And we thought that was a good thing because we have a very sticky user base. What's interesting, I know it's not the topic du jour today, but our B2B business, people are spending even more. So that's also something to keep an eye out on as the world opens up. Yes, there's puts and takes of sometimes, with inflation going up, but also offices returning back to normal. That business was up over 65% for us last quarter.
Wow.
Che, do you think as people buy bigger baskets, the delivery time becomes less important? We've been, for the last few years, progressing towards faster and faster delivery. Does that now go in reverse?
For certain categories, I think you definitely want things if it's tiny pantry items that you needed yesterday. Yes, definitely you're going to see 20-minute delivery. That's a really great service for a certain amount of categories out there. I love that you asked that question, Guy, because it's almost as if you're in our kind of management meetings, because we debate that all the time. And the reality is, when we survey our customers, 70% of whom are out in deep suburbs or rural America. No one's saying, I need a 48-pack of toilet paper in the next 10 minutes. These are folks that are planning. These are folks that are stocking up their pantries. So there isn't that pressing of a need that they needed in 15 to 20 minutes.
Also, real estate has anything to say about it. If everyone moved out of cities and into big houses, they actually have space. I can't imagine storing that in my New York City apartment.
Well, I was going to say...
Che, I have a question for you, though, about how you're running the business in terms of your visibility. There is so much uncertainty. Margins across the board are coming under pressure in general for different industries. How confident are you in your ability to make investment decisions right now?
I would say confident in the sense that we know what we can control. So at the end of the day, there's a lot of things out of our control, but execution on the factors that we can control are really important. So again, talking about data or actual action items. So one is definitely, we just announced yesterday our brand new kind of or extended partnership with FedEx. So being able to really leverage their network to provide 7-day service and potentially even some margin gains, that's something we can control, and that's something the management team here executed on. The second thing is actually when you look at kind of overall service levels for the consumer and also the products that we sell, keeping things in stock, and making sure that they're delivered in full. It's something well within our control. So investing in more fulfillment center capacity, investing in relationships like FedEx, give us the confidence that I think we're investing in the right way.
In terms of what's happening with labor, just one final quick question. How much are you investing in robotics right now? Is the increasing wage story that we're seeing right now encouraging you to do that more? And if you want to do that more, is there capacity within the industrial side to be able to build the robotics that you need?
So I love that you asked that question, because I think it highlights the fact that we build our own robotics. So remember, of course, we sell toilet paper and Oreo cookies, but we also sell software and the entire end-to-end technology that powers our entire business. So on the robotics side, we actually have hardware engineers. So the newest fulfillment centers that we have, those robotics are actually engineered, built, and manufactured by us. So we do have the capacity to build more. But a lot of the third-party robotics providers, there's a long backlog. If you want to automate your fulfillment center now, you're going to get in line. So it's not just going to be months. Sometimes it's years of a waiting list for the key technologies there.
That's such a good insight. Che, thanks a lot. I'll send Guy to your next management meeting. Che Huang, Box CEO. Good to see you. So for more on how inflation is hitting consumers, check out Bloomberg's The Paycheck podcast series on Apple Podcasts. Definitely check it out. It's a really great thing to listen to. We're going to have the latest on Twitter next, as Elon Musk is rethinking his bid. He's staying committed, but the question really is at what price? This is Bloomberg.
This is Bloomberg Markets. I'm Angel Feliciano, and you are looking at live pictures of the principal room. Sylvia Jablonski, Defiance ETF CIO, joins Bloomberg TV at 2 p.m. New York time. This is Bloomberg. Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. Some European Union nations say it may be time to consider delaying a push to ban Russian oil. The problem is they can't persuade Hungary to back the embargo. By putting the oil ban on hold, the EU could proceed with the rest of a proposed sanctions package. The Senate was forced to postpone final passage of a $40 billion Ukraine aid package after Republican Senator Rand Paul refused to allow the vote. Paul is demanding that lawmakers add a provision to appoint an official with oversight powers for the aid. The Senate is now expected to vote on the matter next week. And the stealth wave of COVID is making its way across the U.S. Those who have so far evaded the virus are falling ill, and others are catching COVID for the second, third, or fourth time. Still, the rise of at-home tests have made keeping accurate count of positive cases impossible. Experts say that it's difficult to know what the next few months will bring. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Alix.
All right, thanks so much, Angel. So NASDAQ 100 up by almost 3%. You also have Twitter bouncing off the lows of the session, yet still off by about 9%. The world kind of awaits as Elon Musk says his deal to acquire the company is on pause. Joining us now to break down that impact is Bloomberg's Alix Webb and Sonali Basak. Sonali, I wanted to start with you. What are the bankers telling you right now? I mean, they have a lot invested in interest in this.
Yeah, they certainly do. And remember, he had gone to a lot of parties, not only for that margin loan, which our own Bloomberg Jillian Tan had reported yesterday. He is trying to find new financing to reduce that margin loan quite a bit. So a lot of moving parts at the same time. A lot of people who had been talking to Elon Musk to try to get this deal done. But again, let's look at the merger arb spread here, because that's where the money is to be made and lost in the near term for investors. You have shares really much lower than the offer price here. A lot of questions about whether Musk is going to drop the bid entirely or just renegotiate the offer price. Remember, there is a breakup fee in both directions, Alix. If Musk walks away, it's $1 billion. If Twitter walks away, it's $1 billion. So, you know, the question here is who stands to lose if this deal does not go through at this point?
Let's say it goes ahead, Alix, but goes ahead at a lower price. How does that change the funding requirements that Musk needs to put in place? Can he just use what is already there? Does he need to change that? How would he be thinking about, how would the bankers be thinking about a lower price in terms of the way that it changes the arithmetic in terms of the money that is needed to be raised, how much equity could be included?
I mean, presumably the issue is that if less money is needed, that means that either you are requiring less from the banks because you're going to be taking a bigger share of it yourself, or proportionally, they're still going to be supplying the same amount. Maybe they're even supplying a greater amount. The odds are they do not want to be probably taking a smaller, if they're actually getting some equity out of this, or some rights to equity if it's preferred equity funding, which is what the latest reporting suggests might be the case. They may not want to be taking a huge amount of dilution. Fact is, we don't really know. The difficulty is, of course, would they prefer to have a lower price? I'm sure they prefer to have a lower price. So would Elon. Do Twitter's investors and Twitter's board want a lower price? Well, that's a different matter entirely. They were told that they didn't think the board was told that by their investment bankers, they did not think that the share price could, without this bid, reach 54.20 on its own anytime soon. There are still people who rate the shares, sell-side analysts, who had price targets in the $60 to $70 range. So there isn't even agreement on that point. Ultimately, it's more confusion, which is something the SEC is not going to like.
No, I was going to say, the SEC is going to be probably all over this. It's not the first time that they've kind of gone after Elon Musk. Alix, I wonder what you think we're going to see out of D.C.
I think there's no way that the SEC will not look at this. That if he has tweeted something as a joke, which remains a distinct possibility, then they will be looking at it. If he has tweeted something because he is reevaluating the deal, well, that should probably have come through the form of a regulatory announcement, so they'll be taking a look at it. Now, of course, Elon is supposed to have a lawyer who evaluates all his tweets, but I think I'm right in saying that the SEC stipulations imposed a few years ago after the famous or infamous fund secured tweet only pertained to Tesla shares. And this, of course, is not pertaining directly to Tesla shares. It pertains to Twitter shares. So there was supposed to be a Tesla lawyer evaluating his tweets if they have relevance to the capital markets. This is about Twitter, so it's a little bit different. Maybe it's wiggle room on that particular stipulation.
Sonali, just to come back to Alex's point about kind of how much the bankers are going to want as a share of the deal if it is reduced, what is your take on that?
I think one part of this is equity, is not just the share of the deal if it's reduced in terms of the equity partners, the many, many equity partners he brought on in terms of investors. I think the preferred equity financing that we reported yesterday was also interesting. 20-year maturity, interest to be paid in kind at a rate of 14%. This is Apollo and Sixth Street in talks for such a deal. So the structured financing here is definitely something we saw come to the fore, in the middle of COVID when people needed financing, and now in a much more aggressive way of one of the largest LBOs of all time. You guys were talking about what happens if a deal doesn't happen. I think this is also important. If you look at what Cowen & Co. is estimating, they're using a $30 downside for Twitter if this deal does not go through. I think what's interesting here is how is Musk going to get that value out of Twitter over that 20-year horizon, over the scale of the preferred financing guy, but also in that quick turnaround that he told bankers that he would potentially be able to accomplish if he could take Twitter public in a shorter time frame as well.
Yeah, I have to wonder too, Sonali, just in general, how unusual is it for bankers to deal with sort of this key man risk, a huge deal, big breakup fees, and then this kind of volatility? Like, they're not used to this kind of thing.
No, and I think that's why when you look at the way people are creating structuring around this financing, they're really protecting their downside. You're not seeing Apollo walk in with an equity check. You're seeing them potentially walk in with preferred financing that protects themselves on the downside. And when I speak to bankers, they felt the same way about the margin loan, that they were trying to protect themselves while also getting in on one of the most exciting deals in technology, perhaps of all time, with the way that this is playing out. But remember, I think one thing that's interesting is the amount of investors that said that they would still want to get into this. I had a conversation on Friday with Keith Raboy, a Founders Fund, who is an investor in SpaceX. And one of the things that he said was that if he could get in legally, he would. They have some conflicts there, so they can't get in. There are investors who do want to get in despite the risk because they believe in Elon himself, which is how the banks have felt about Elon for a very long time.
Absolutely, and they've been rewarded for that. Wedbush now saying that the recent developments turning Musk's bid into a, quote, circus show. Sonali Basak, Alix Webb of Bloomberg Quick Take, thank you very much indeed. This is Bloomberg.
Equities, yes, they're rallying today. The Nasdaq 100 now up by 3%. However, we're still looking at a weekly loss, and we're looking at a consecutive 6 weekly losses for the Nasdaq 100. That's the worst that we've seen since 2012. Now, another poster child of that turbulence is Cathie Wood's flagship fund, the Ark Innovation ETF. Obviously, been caught in the sweeping sell-off of tech shares this week. Now, that's leading the fund to argue that the market is mispricing the fundamentals of companies favored by Wood and her team. She also blames the Fed for hiking too much too fast. But Cliff Asness, the co-founder of AQR Capital Management, isn't buying that response. In a now deleted tweet, he told the ETF firm that they don't get to use the word fundamentals, and that AQR was right and Wood was wrong, and that she and her team have no sense of irony. I mean, sure, but let's be honest, Guy, AQR had negative returns in 5 of the last 6 years. It feels a little early to be throwing some shade.
Well, I think his point is not on her performance. It's her it's kind of the methodology that he has an issue with and the fundamental analysis. She's talking about, Cathie Wood's talking about kind of deep value here. And I think Chris's point is that is not kind of what everybody else is seeing, and that the methodology that is being used here, and he's obviously a quant,
sure,
is erroneous. Now, and I think he's being very clear that he's not criticizing the performance, because as you say, he went through a very long period of time of underperformance. So he's not having a pop there, he's just having a pop at kind of the whole idea of fundamentals and valuations and all of these tech stocks. It was interesting. So earlier on in the hour, we were talking to a guest that was talking about a permanent, obviously nothing is permanent, but a sustained period in which these valuations for some of these big tech names are going to reset lower and stay lower. And I think that is the danger that Cathie Wood now faces here.
Yes, and I understand, but really, like, you know, deep value and quants, they're just different. I just feel like it's a potato thing. Anyway.
Okay. Well, we'll park the potato debates. I think we're going to continue with it, but we'll do it in the next hour. Right now, let me update you on what is happening with markets, because as Alix says, we're a little off to the races this Friday, maybe the 13th, but it doesn't seem to be scaring the market very much. Equities are significantly higher. We're up by around 1.9%. The euro is higher, but still trading with a 103 handle. Brent crude is definitely flying. Brent is up, trading 110, nearly 111, 3.2% to the good. We'll talk to Matthew Severay next. This is Bloomberg.